really nice, and thank you for being here. If you're having a good time, relaxing a bit, enjoying some food there, we have this awesome panel sitting here with us. I'm just going to start introducing them from my right. So on my right is Mark Hong, and Mark is the chairman of Business Angel Network Southeast Asia. He's a former professor based in Europe. He has brought startups from concepts to IPO. He's also an investor and venture partner to venture builders and venture capital funds. Next to Mark Hong is Mark Sees, and Mark Sees is the managing director of ASEAN Company Hong Kong, a leading global co-investment group specialized in direct investment across stages. ACE focuses on unique opportunities in the most attractive industry and markets on a risk-adjusted basis. Right next to Mark is Alex Sees. Alex Lin. Alex Lin is the head of Infocomm investment, and he led the team of investment professionals to develop the income startup ecosystem in Singapore through strategic investment in promising companies. Then, of course, we have Khailee. Khailee is the managing partner at 500 Startups, the Silicon Valley-based venture capital firm. And lastly, we have Erman Akinci of Catcha. Erman is the director of Catcha Group and a senior partner of Catcha Ventures, the venture arm of Catcha Group. Catcha is one of the region's longest running tech investment firm, having brought 4 companies from startups to IPO. So that's the beautiful panel that we have today. Let's try and make it more open panel, not just with us, but everyone sitting here. So I'm just going to start off by asking specific questions to the panelists, and I'm going to start off with Khailee. My question is, I attended the Tech in Asia in Japan last month, where Dave McClure, he announced that 500 Startup Japan is in the midst of raising $30 million US fund. As the managing partner for 500 Startup Asia, how would you describe your fund thesis?
Yeah, why am I being picked on as the first one? I think what we've done with Japan and the 500 Startups Japan Fund, which is a $30 million fund, is just like one small piece of the larger picture that we're trying to paint for the world. The way we look at raising a large fund is not by having, like, say, $1 billion fund and hiring a lot of people and deploying different markets. We want to scale our organization by breaking ourselves into smaller pieces. We imagine ourselves as a family of funds, focusing on a lot of micro funds, on country-specific, vertical-specific. So in executing this project, we have now 6 funds that we launched in the past 6 months, including 500 startups for Korea, called 500 Kimchi. We've got 500 startups just for Thailand, called 500 Tuk Tuks. And then 500 Japan, we're trying to be culturally sensitive over there and be a bit more picky about the names that we've come up with. I know, 500 Godzilla didn't really hit the right chords as well. So we've announced just last week 500 Turkey, and that's also in process of being nicknamed, yeah. So we wanna have micro funds for each country and micro funds for each vertical. So for example, mobile first and mobile only, we've got 500 Mobile Collective, and we believe this strategy can entice like real specialists in specific markets or specific verticals to become fund managers. And at 500 Startups as an organization, we can give a lot of fund management expertise and best practices to help these fund managers really go out there and do their thing. So in some distant future, how we want to invest, I mean, we've done, as she's mentioned, we've done 1,200 companies in 50 countries in the past 5 years. We're doing a deal every 1 or 2 days. Every day we're doing 1 or 2 deals. But what we really want to do is get to 100,000 deals all over the world. And we think the only way to do it is by reinventing ourselves. Instead of being 500 startups, to become 500 VCs. Over time, this thesis reflects more of an index fund than a VC fund. We believe that small, medium enterprises will grow very big. A lot of them can be indexed. You just take the cream of the crop and index it. And so maybe in the near future, we'll resemble a bit more like an index of privately held companies which are urban. So that reflects our thesis.
awesome, and definitely interesting names that you're picking up for.
Tough, man.
It is, right?
It's the toughest part of the job, finding the right name.
Great. I just want to address my next question to Mark C's. ACE, as we know, it has a global investment portfolio that ranges from angels through growth and buyout. Having the global exposure, can you help us draw a parallel between Singapore and Silicon Valley?
Sure. So I think one of the successes of Silicon Valley, which most of you probably know, is the fact that it has a three-dimensional aspect in terms of what got to their success, which is providing infrastructure, a funding platform, and then obviously fantastic education network. And so Singapore has been trying to do that and copying that model, that tech model, and bringing it out here to Asia. They've been very successful in the funding space. Singapore has now been the biggest VC platform funding in all of Asia, ahead of Hong Kong, Korea, or even Japan. And I think they've done a tremendous job at infrastructure as well, creating spaces where actually accelerators, incubators, have attracted now even foreign VCs to come, and great talent in terms of new startups, being able to while being bootstrapped, develop their products. So I think Singapore has a lot to draw from the experience of Silicon Valley. I think they've been very different in terms of funding. So one of the big differences which you see compared to Silicon Valley, where most of the funding is coming from private capital, here it's still government grants. It's shifting, but it's still at a slow pace. The other big advantage, which I think a lot of Singaporean startups are witnessing compared to the Valley, is a much lower competition. In Silicon Valley, everything is cutthroat, whereas here you still see some business concepts, if done and executed well, can actually work and then go to eventually a Series A later on. So I think Singapore is still in its early, I would say, infancy stage of creating kind of a Silicon Valley hub in tech. I think one of the most important factors that we have to build on is the third point, which I mentioned, is education. I think that's a major point for creating the new leaders of tomorrow. And also in terms of sectors, probably diversifying away from tech, which we've seen there's been a lot of successful Singaporean companies or incubated companies in the tech space, but it's usually tech replicas rather than tech innovative companies, which we still see most of them coming out of the US and to some extent Europe. But I think where Singapore can really make a difference going forward is probably focusing on some of the sectors where they have a huge experience in terms of heritage, such as financial services, and eventually become even a fintech hub and kind of specialize themselves. So we'll see where it's going, but it's definitely had a big success in the region, at least for Asia.
Yeah. Thanks, Mark. Just on that, and as you mentioned, that there's sort of a replica that we're doing in Singapore, trying to replicate and concentrate just on tech. And that's what we somehow see with most of the government-specific grants as well. They are more around tech. So I just want to ask the panelists, would you agree that we should be concentrating on different sectors here?
I think I'll jump in quite quickly on this one. Is that I'm not really fully government, but I'm wholly owned subsidiary of IDA. Now, one of the perception that we have is a focus on tech, but the underlying reason about focusing on tech is that we are focusing on innovation-driven company, IDE for that matters. Now, the difference is that Singapore businesses, traditionally, we have a lot of system integrator. System integrator, they could be tech too, but then they're buying a few of technology, assemble it, eventually they sell it to factories or company to do that. Now, we notice that such company, the scalability is weak and require a lot of manpower, which is something that we are not having a lot of them. While looking at a scalable company like, for example, that those that have own technology, and they're able to scale quite highly, although the initial period they may be suffering a lot of loss because of while you're building the product, there's a lot of cost down there. But eventually when they scale, manpower requirement and all these things are much lower. We studied a few of the example company, take robotic for example. 7 years ago, there are two companies, one in Singapore, one in Taiwan. Both of them are together, starting at the same time. Singapore company take the approach of a system integrator. Fast forward 7 years, it's grown to about 40 million in terms of revenue, but its market capitalization is only 30 million. But when revenue is much higher than the capitalization, you know that the company is in trouble. And 1.5 years ago, he transformed himself into a property company by acquiring a property company. But you look at the Taiwanese company, work very closely with the university to develop the technology, his robotic arms and everything, and he begin to be able to create much better job. Lower cost of product, but higher margin for manpower as well as higher margin for himself. It become a $400 million revenue company and market capitalization of $1.5 billion on the global robotic market between 3 and 4%. Now that is the kind of difference that we are focusing. We're focusing on a technology-driven company versus just tech alone.
Yeah, I think it's something also, I mean, let me just interrupt here. The tech in and of itself, like, it's taken a much broader meaning, right? Back in the day, we talked about robotics, right? I saw a pitch by a company that makes exoskeletons, right? So you can run faster, jump higher with exoskeletons. Man, that's some hardcore tech up there. But like a lot of companies say, I cut a check in a Grab taxi, like akin to Uber. Like it's primarily a transportation kind of company, right? But there's like a very thin tech layer on it. You talk a lot of e-commerce today. They're more and more resembling traditional retail in logistics, warehousing, acquiring, buying of goods. You know, website and like advertising on Facebook to getting customers, having an online checkout. You know, it's as thick as the tech gets. So there is a world we're living in now where Andreessen Horowitz invests in Soylent, which is like food, like substitute powders. So I think that the broadening of the definition of tech is what's making this conversation a bit more nuanced, right? So it's very, very broad right now. And all fund managers, in the end of the day, you could say you want to invest in tech, but if you've got a deal that's going to make you a lot of money, you know, you might want to cut the deal as well. They call it a tech deal.
Okay, thank you. Just coming back to just coming back to Alex there. At one of the Founders Forum held recently, you mentioned that Infocomm investment over the past 5 years has brought to Singapore more than 100 Silicon Valley startups who wanted to expand into Asia. Can you help us understand what is the driving factor and how is it related to the Smart Nation concept?
Let me just give a little of context to it. Is that, as Mark just mentioned it, Singapore seems to know what we are doing. All right, a lot of times that people think that we really know, have everything planned out, we do a lot of analysis. The fact is that I don't think we really know in detail all the things that we are doing. We're still experimenting quite a lot of things. So 5 years ago, when we have a program called Akinci, the purpose is to figure out that how can we bring more engineering center into Singapore. That's where the starting point is, because we always think of creating jobs. Now we have an investment manager going all around the world to bring the startup in. So it's about 152 of them. We took them in. And of course, the very first thing, the easiest thing to do is dangling investment, subsidies and everything so that they will come in. Okay, that is a very, very common perception of it. But we realized that this company come in not because of investment. All 152, less than a handful of them need those money. And you can imagine that it's a very, very big surprise. 73% of them survive. They stay in Singapore and use Singapore as a springboard and move around Asia. The rest of them, the product market doesn't fit this place, they went back eventually. Over 60% of them came from the Valley, and the rest of them, the rest of the world. And when we start looking at this data, we realize that there's something that we didn't do right. This is that our assumption was being challenged. We realized that what they need is actually market access. So the program shifted by helping the company to access the market, by bringing them around, leveraging advantage of government that we can do G2G call, introducing all over the place. Now that becomes a certain attractions, and we begin to understand that company need market access more than company need just funding alone. And we also know that government being a little bit rich, there's a disadvantage because we literally crowd out the market player, the investment. Right? Because even I myself being a VC of a government have grants competing with me. I would have people would tell me, they say, why would I take your investment where I lose my share, while I can get almost the same amount or even more just for government grants. Right? So we begin to realize that, and we're now making adjustment. Now, how is it related to Smart Nation? Smart Nation is basically a concept. The concept that covers a lot of things. Now, what we are trying to do is to using technology and our understanding of the data and ecosystem that build things that are better for people's life. In order for us to do that, why are we doing that is basically that in terms of business-wise, that it makes sense. Things that help people to improve themselves and be better, the chances that there's a market for it. And that is the reason why we go about doing it. So we're looking for companies that are able to solve big problems. Most of the people are not aware of the kind of big problem that are existing out here. Take for example, food. Food in Singapore, large majority of food we eat, especially vegetable, about 97% of them are all imported. So sometimes I'm jokingly telling the environmental friendly person and say, look, we don't eat salad out here. Because every bowl that you eat is about 5 kg worth of carbon footprint that you increase. So everything is imported. Now, if we are able to plant in Singapore, which we don't have a lot of arable land, then it will change a lot of things. Because the local transportation, all these things help reduce a lot of carbon footprints and make the thing fresher and all these things. So, but behind all these things, that although you think that it's agriculture, but the fact is that it is very deep in Infocomm technology. Because the control of the plant, the so-called the light, the nutrients, and the microcode for all these things are all electronics and all software. And you still have to talk about the distributions, okay? Distribution of the food. So these are the things that we are looking at in a smart nation context. We are looking at things that typically aging populations, financial technology is another area that we are very, very much focused on it, and we are trying to work on how to work with the global ecosystem to build a fintech hub on it. And cybersecurity. Cybersecurity is one of the areas that most of people take it for granted. Although the genesis of it is when we work on bank, fintech, then we think of cybersecurity, but we realize that banks actually don't really need that much of cybersecurity because most of the banks, no matter how screwed up they are, eventually they still stay. But we've seen a lot of examples of it. And we realize that, look, maybe it's not really banks that need so much of cybersecurity, but actually the area that need cybersecurity is actually digital health. Digital health. Imagine that if I am able to compromise your health record, I will owe you for life. But if your credit card is being compromised, at the most you lost about 10,000, okay, within 48 hours once you cancel it, pretty much out there already. So that is the kind of severity cybersecurity have the impact on the digital health, and this is where new area that we are focusing on and looking for. So in a very, very conceptual stage, we pull back and say, okay, we need to look into all these areas. And these are the investment in the future. But do we have such company around? It's not easy to find. We have more money chasing for good projects. So what can we do? So that is the reason why we started a new strategy that we work on Accelerator. Because if there's no company to invest, then even if you have money, that's quite useless. So what we did is that, work with Accelerator, people like 500 that constantly look at all the small ones. We invested in 6 accelerators so far. We're going to invest in a few more, just to help groom. And we came said it is farming, farming startup. So hopefully, with accelerator and incubator, we're able to push them to the starting line as fast as possible. When they reach the Series A, that is when we will jump in and we invest directly. So this is a strategy. But are we sure that we're going to get there? I'm not too sure. But this is a good experiment. I think it's a worthwhile experiment for us to do that.
Maybe just to very quickly jump on what Alex said. I think it's really important because what people don't realize is that early stage access to funding in Singapore is very easy. So everybody can get up a startup and create it. It's more what he was mentioning of the future funding for the Series A and really the growth of the company. And there it's much more difficult to get access to capital for a lot of these companies. And one of the main reasons, and we briefly touched upon this, is the fact that in Singapore, your market size is really small. So all these companies have to expand, and most of them, and that's what we do a lot at Asian companies, we help them relocate and focus on other markets. That's where business development becomes absolutely key, and where you see a lot of even successful companies in Singapore just staying small. So it's very hard for them to expand overseas.
Put Mark comment into context is that there's a lot of early stage funding is all over the place. Now, is it good? The answer is actually not good because when the funding is easy, the startup themselves are not working hard enough. So the probability of them reaching Series A to become a viable investable company is low, which is the reason why we start Accelerator, because within the 3 months, they have to be able to come up with a viable business model, at least validated, minimum viable products, and a book pitch. So these are the 3 things that you push them through in order for them to feel that. So it's very, very important for us to do. And that will help the ecosystem.
Thank you. Thanks for that, Alex. My next question is to Erman. And in my introduction to you, we know, as stated, that 4 of the companies are listed on the ASX in Australia. Can you just help us, how has that experience been from taking your company from the startup stage onto the IPO stage?
Actually, it's 3 companies. One is listed on the BANSEA in Malaysia. But I guess the important point to note about the ASX listing strategy for us was it was more a function of necessity than it was really some strategic design. At the time that we decided to raise money for the first IPO, which was iProperty, we actually had a really tough time raising money from the more conventional PE, VC routes. And this is sort of mid-2000s when the VC industry in this part of the world was very nascent. So we actually struggled tremendously to raise that capital. And so I think it's important to note that it was a matter of necessity. And it was also very different from how people view IPOs as being a later stage exit or liquidity opportunity. For us, it was very much a funding opportunity. And the reason that it worked on the ASX was for, I think, 2 core reasons. One is quite unique to the ASX. A lot of investors in that market have a particularly unique view on risk. They were very comfortable with a lot of early stage risk. And I think the thesis is that it comes out from the fact that they did a lot of weird mining deals back in the 90s where like a bunch of random people could show up with a concession to mine somewhere in Mongolia, and they'd raise 10 million bucks and go off and dig holes in the ground. But it meant that they were very comfortable with that early stage risk. The second thing that worked in our favor for the ASX was that the business that we wanted to list, which was iProperty, was a property classifieds business. And on the ASX at the time, there was actually 3 sizable classifieds businesses, actually 3 of the largest classifieds businesses in the world are listed on the ASX. That's Car Sale, REA, and Seat. So the strategy worked because we had a really good case study that we could use. We had a hit list of investors, and the pitch was pretty simple. At the end of the day, it was going to those investors that backed REA, that backed Seat, and said, hey, you guys like REA, you like Seat, you like Car Sale, well, we're going to be the REA of Southeast Asia, and that worked for us. So, I mean, going on from there, once you have one success on one market, you get a following with investors, it's easier and easier and easier to do deals on that market because you have a following, you have a reputation on the market. So, I mean, going back to the question, how's the experience been? I mean, it's been good. I think that there's always downsides to to having a listed entity over a private entity, and we've had to manage those over the years. But as a whole, it's been successful for us. It was a very good way for us to raise significant amounts of capital at the time. And now what we're seeing is that the learnings that we got from that experience are transitioning into a new set of value adds for the businesses that we're looking at now, who are potentially seeing it as an exit opportunity. So we started off doing it as a funding strategy, but now the businesses that we're working with are saying, oh, okay, well, this is a potential exit strategy, and who should we be working with? And fortunately for us, we've got a lot of experience on there.
All right, thank you. Mark, we know that BANSEA assists with a lot of very early stage investments. Can angels and VCs coexist, and do you work with VCs?
Thank you for the question. So BANSEA is a non-profit organization of accredited investors. So we get together, we look at deals, we fund early stage startups. We have our place in the ecosystem, so we're at the bottom of the food chain, right? We fund promising founders, we fund ideas, but as you can see from Alex, clearly Alex has more money than we do, and he's starting to encroach into our space, which is not good news because we manage our own money, so our bank accounts are naturally smaller. They have a larger bank account, so but we do have a co-opetition type relationship because we do co-invest in some deals. Some of the companies that we invest to do graduate and they go for Series A funding from the VCs. Some of the VC GPs eventually become angels as well as a hobby, and the angels also move up to become maybe GPs of funds or LPs of venture capital funds. So that's so in short, yes, the relationship is getting complicated with all the crowdfunding sites and syndications. We are also moving towards coming together, setting up micro funds to invest as a group as well. So.
Thank you, Mark. Thank you. I'm just going to open up the panel here if anyone's got any questions. Come on, I'm sure we have a few questions here or
I
there.
think we put everyone to sleep.
Yeah, who was that?
But maybe just to jump on what Mark was saying here, it's, you know, before people had a very clear idea about, oh, okay, well, angel investing, VC and private equity. Today the lines are very blurred. We had a discussion yesterday with Khailee actually, where even from concept stage or business plan stage up to Series A, I mean, there's a whole road, a horizontal road of stages of funding. Today the lines are very blurred, and we see because we invest across the stages, and we partner up with incubators, with accelerators, with even angel investors, and then with VCs and intermediate mezzanine funds, etc. So today it really more matters, I think, really about the actual company you're investing in and making sure you have the right partners. And today it's become a very collaborative crowd of people investing together. So 10 years ago you'd have big private equity funds that would only do control deals and that's it. And they would not share a deal with anybody. Today actually these big funds, even them, they're moving down in the vertical chain and looking at growth deals, doing minorities, etc., etc. And we're seeing the most value add actually we've brought is bringing several investors onto the table in a single deal. And that's whether it's on the early stage, of teaming up with 500 startup other accelerators and incubators, at the growth stage with other VC funds, or even at the private equity level. We look at over 900 deals a year. We've partnered up with some of the most well-known names in the industry. We bring them deals, and we share the pie. And I think there's a lot of value add when you have more smart people around the table.
I think you're bringing this discussion to something very interesting because everything that we know about VC in the past 1 to 2 years, I've only been doing this for 2 years. Even in 2 years, you see from month 1 to month 24, right, of how things are changing. Abby pointed out. I think another force of change that people sometimes fail to ignore is actually the role of corporates and also the role of family businesses. So there's a new breed of investors competing with angels, competing with VCs, or either sharing the pie or growing the pie together with us. Corporate venture capital firms, they're out there, they've got money and they're ready to spend. And some companies in the Valley, let's say DocuSign, the entire Series E was done with corporate VCs from multiple markets around the world. Not a single VC or investment bank was involved in the Series E of that, all corporate VCs. You see family offices, so a lot of, say in Korea, the chaebols, or whether you've got strong families in Philippines or Indonesia or Vietnam, Thailand, these family structures, under the family wealth, sometimes the family, they've got a few kids, a few cousins, and some of them say, you know what, I'll take the family business into the world of tech startups, right? I'm going to build the future of the family business, right? And if you get allocation, I mean, it's not a small allocation, like a new Indonesia fund is $150 million US for the kid to invest. Right, so that is more than a lot of average C funds and angels, right? It's they have 150 million check. So I think to have these new entrants from corporate and as well as family business, it's just a sign of how exciting this scene is becoming. But it also forces fund managers to adapt to all of this.
Yeah, I think that the key going forward is going to be this additional value add, right? Because basically, capital is becoming commoditized. There's just going to be so much of it around. So the way that you differentiate is really by figuring out those additional value adds, those strategic value adds, those networking value adds that are going to differentiate your capital from just money. You know, and I think that's going to be key to driving that growth going forward.
And this seems to be a common theme because I know Alex, you touched on it, right? You're saying that they don't just want money, they want market access, right? And then you're doing all these other different things to try to add value. And, you know, with helping them this in Australia, for example.
Yeah.
So, yeah. Questions? Who are you guys? Like, you guys came into this room and sat down. Some of you like, oh shit, this is paneling for me, but I'm gonna check my phone. Then there's the rest of you. Some of you are looking really attentive. Wow. Yeah. Some of you apparently find this stuff interesting. So, like, what did you expect this panel to produce, right? At least we can collaborate and produce that.
Looking for the next Facebook of Asia. But no, I think what's interesting is that today everybody's looking, you know, for more startup investments. And interestingly enough, you know, you look a few years back and people say, oh my God, no, startups, you know, super high risk, you know, no idea, etc. And now everybody and his grandmother wants to invest in the next Facebook, Twitter, etc. I think because of the availability of capital, which you just mentioned, it's becoming harder and harder and harder. And we've seen that actually. We look at so many deals here. We have to be extremely selective. And I think a lot of people, you know, want to invest in startups and they say this is absolutely fantastic. As Khailee mentioned, you have, you know, family offices saying I'm just going to do startups. The reality is that the failure rate is extremely high because we only always hear about, you know, the successes, but for, you know, every success there are, you know, millions and millions of companies who fail. So I think that's where, again, you know, collaboration and, you know, people working together and working with smart people makes a huge difference to actually, you know, backing champions.
I think one other first we can do as well, like, is to help grow the market and to increase the supply of quality entrepreneurs and quality businesses, right? Because we know money's coming in, that's for sure. There's like avalanche of money everywhere around the world for this asset class of tech startups, right? So one way we can collaboratively do together in the industry to help grow more great entrepreneurs, explore new horizons and new ideas. One thing which we care a lot about at 500 Startups is just lowering the bar to creating a startup. So in a way, Tony Fernandez and Ari just says now everyone can fly. I mean, we're not trying to have like now everyone can create a startup because in reality you can't, right? But we don't want someone who's like super motivated, super driven, super competent, and all because they're in Myanmar, they don't have the same opportunity as someone in like Sand Hill Road. I mean, that's just a world that's not fair. So what we're been actively doing, like we're launching free legal documents for like convertible notes and pref shares across Southeast Asia. We've been because we've been organizing a lot of events in the Valley and we've got the license to all that video, we want to work with one of our portfolio companies, Viki. They translate Korean drama into different subtitles. We want to subtitle Mark Andreessen talking about some shit, or you know, Dave McClure talking about like growth metrics for pirates. We want to translate that to 180 languages. We want to get that content out to places who haven't heard of startups. You know, so we imagine a world where anyone who is capable and competent enough, they can create a startup that would build a community and build a lot of business value, and then all of us and all this money is a place to go. So.
And that's pretty good, and you know, I think that's a very good cool hack that you sort of discovered to find the right startups.
But at the same time, it's the only thing we can do because we're not going to increase the supply. All of us are going to be overpaying for deals. This asset class is going to continue to be a crappy asset class.
Yeah.
Because all of us are overpaying for the few good deals that actually get produced. You know, all of us are going to be in this chokehold position. So we have to rapidly lower the bar it takes to create a fundamental startup.
Also, I think that it's important, you know, that mindset of adding additional value is important not just in the super early stages. I think that mindset needs to translate through the whole spectrum of you know, the growth story of a business. You know, a business goes through very different challenges as it evolves from being a startup, a very early stage startup, all the way to, let's say, going to an IPO. And so it's important to have that mindset throughout every single one of those stages and to have partners that have a value add at each different stage and can contribute to the specific challenges that that business would be going through at that period in its growth or its life.
Absolutely. Like one opportunity that we've adapted to is that we realize that nobody gives a shit about small exits, but we like small exits because we still make money. You're a seed investor, you come in at 1 million valuation, the company gets sold for 8 million, that's okay. You make some money, right? At least it didn't go to zero. So, yeah, man, it's not too bad, right? So what we did was that we've already built out an internal M&A team, And so we liaise with all the corporates around the world who are interested in index exactly what they're interested to look at. And we're that middleman to help M&A small exits. So we don't need to wait for huge billion-dollar unicorn exits. We can help a lot of smaller companies get sold, and that again puts money back in the ecosystem, more serial entrepreneurs creating more companies, and you got a virtuous cycle that we all can benefit from.
Yeah, I think that what Khailee touched on is very valid actually. We've just recently invested in a company in Singapore at the seed stage, and it's a fintech company we know quite well, and we've invested in a much bigger company doing exactly the same in Europe and in the US. And typically there, the value add of being a global player is we might be able to actually help that global player even absorb that company. So it's two portfolio companies, but we're doing internal M&A. I think that's where you shed the real added value, be able to help a lot of these companies go to the next level.
Just to add on to what Khailee mentioned about it, some of the opportunities only when you're working on it, then you can see it. One of the key areas I mentioned about is the corporates getting the hooking. And initial reaction is that as a VC, you say, please don't come. This is our game, and it's not your game. But when you start looking at it, is that while we're doing acceleration, we notice that there's a few things that corporate has that is very valuable to the whole ecosystem. Number one, they have a customer base, they have an infrastructure, and they have the domain knowledge. So these are the three things that we are working on it, and we realize that. So we start bringing corporate in and experimenting, we bring startup and try to match them up. Interesting statistic is that we bring a large FMCG company, introduce them to about 67 startups, go through some speed dating matching process, each one spend about half day. Eventually 32 of them got the chance to work with the corporate, and 12 of them got invested in corporate. Now you begin to see that is begin to shape the business model. Imagine that you are just using doing a so-called prepaid card on the phone, or you work with corporate in India. And now your prepaid card can not just use it for phone, but also to buy for soap, toothbrush, toothpaste, etc. And the model totally changed. And that kind of opportunity is being created. Now there's something that we are still working on, but we couldn't figure out exactly how to do it. So if any of you know how to do it, I'll be more than happy to hear. Is that we mentioned that we have a lot of system integrators in Singapore. Some of them easily have about 40,000 customers. Now, these 40,000 customers as a system integrator is very simple. It's day-to-day running of installation of modem, IT support. It's boring kind of business that nobody wants to do. Now, the revenue eventually every year, okay, you can get a profit of about $1 million, maybe $2 million. You really cannot see much upside. It's not really investable. What if we can bring in innovative company that can access to this group of customers and let them do an M&A? And immediately you can see that this whole thing can just go and go up. We did try, not that we didn't try, we tried, because anything that only theory is useless. We always believe that doing is learning. Okay, learning is not doing. So push them, and then we try to get them to work together. Doesn't work very well. But we see the opportunity. Eventually one guy did try, and the company transformed. From a system integrator, become a product company, and growing very well, and move on to a much larger market. Which is something we also experiment with. They bring a company overseas. We're looking at, I just came back from Taipei, and I noticed that they have very good technical capability. Wow. They don't have very good business development capability. So they're able to produce fantastic products, but they don't know how to sell. While in Southeast Asia, we have very good skill in terms of business development, packaging, and all these things. And we were just sitting down and said, why not we be able to form teams across the boundary? Right? We have a Taiwanese technical team and Singapore business team, merge them together, and now you have two companies, one in Taiwan, one in Singapore, addressing two markets. So these are the various things that the opportunity they have. This is definitely a very confusing stage, right? Nobody really knows what is going to happen, where are the next unicorn come about. But I think with all this effort, I think we'll be seeing some of them appearing within the next 2 years.
Thank you, thank you. Marco, I just have a question for you. Obviously, based on this discussion, how are you trying to adapt? And also, I understand that your funding is very early stage. So at that point in time, the whole proposition when someone comes to you, it's around idea. Do you find it hard to value and do the valuation at that point in time because you don't have any metrics at that point in time?
Yes, I think those two questions. First is, angels usually invest between 10,000 to 250,000 per transaction. When we look at ideas now, we are a bit concerned because some of the founders can have a really nice pitch deck, but they can't execute. And some have really, really ugly pitch decks, but they're actually multi kind of exit type founders. So it's going to be quite tough. We currently encourage to reduce our own risk. We encourage them to get some form of traction before we put money in. And on the second question, yes, angels are choosing strategies now to avoid VCs, so we don't kind of compete at the same time. So one of the things that I mentioned earlier we do is we do syndicated investment deals where we have 10 angels come together. Just think about it. At the end of the day, most of us in this room are investors. What are we selling? We're selling money, right? Why is my Ben Franklin, why does it smell better than Alex? Dollar, right? So we're all saying, mine's nicer, mine's better.
Best
So,
friends is good.
Mine's better.
yeah. So this is so we've taken different strategies. So myself, I've also invested in a venture builder where we build companies. We fund it all the way, and when we hit Series A, we can co-invest with VCs as well to bring the company to a later stage. So,
Thank you, it did. And understanding that most of the cities will become and provide funding at different stages, I would probably like to know how do you guys get funded? I know it's different at different stages, but probably starting from you, Khailee.
I would do first because mine is the easiest. I only have one LP. That's government.
Thank you.
Yeah, so we are, for us, it's quite an interesting story actually. We started out as a family office, and what we realized, we were allocating money to large private equity funds since the 80s. We were one of the pioneers going to hedge funds and private equity at a very early stage. We seeded Carlyle actually in the days. And what was interesting is that over the years we realized that performances from all these alternative shops was getting worse and worse. And the reason for that mainly is because once you get to a larger stage, it becomes much harder to deploy large amounts of capital and get that same type of return on investments. So we said, well, actually we should focus more on direct investments about 10 years ago and see how that will go and monetize our co-investment rights. And we still had to build a really good track and realize that most of the direct investments we were going into were actually producing better returns than the fund returns. And so we've expanded that platform. And then, some of our other families came along and said, well, actually what you guys are doing, makes a lot of sense. And it's very hard to do direct investments because the amount of work you need is, most of the time underestimated by a number of players. And so we've expanded that platform, and most of the investors today are family offices, and now we're having institutionals because of the track record. And so then it builds on.
Yeah, I want to be like Mark one day. We're still kind of young as fun, 5 years old, since 2010. So most of the institutionals are waiting for us to pass the 5-year mark at one full fund cycle. But nevertheless, we've been very fortunate to be supported by a lot of believers in our vision. So from high net worth individuals in tech like Sheryl Sandberg from Facebook, or Mark Cuban, Mark Andreessen himself, Eric Schmidt is also an investor in our fund. So those are a set of early believers. And then the other set of people who fund us are mostly corporates. Corporates want to have as large of a startup index as possible. They want to know what's going on everywhere all the time. And so in Japan, for example, in fact, 20% of all capital comes from Japanese corporates. From Recruit all the way to Nisha, SEAPEC, Yahoo Japan, name it, so 12 different Japanese corporates, at last count. Korea, so recently GS Shop. So a lot of now Korean conglomerates getting more interested. So corporates is the other group. And then the last group, of course, is family offices as well. There's like a lot of them out there. So yeah, so far we've been fortunate enough to be supported by a lot of them.
Well, I mean, the short answer is from wherever we can get it, but as I was mentioning earlier, we did a lot of our earlier stage fundraisers off early stage IPOs, and that's where we got the bulk of our capital. We're starting to see a shift both in our own strategy, but also where we're seeing interest and where we're seeing potential sources of capital. Just sort of mirroring what the guys said, we're seeing interest in a lot of interest from corporates. We're starting to see an increasing amount of interest in from family offices, and now I think a little bit more from more conventional institutional investors. I guess the overall message from my side is I'm seeing sort of across the board more interest growing in all of the different potential funding for potential LPs.
Okay, thank you. Park Yusan.
For me, it would be like a KYC. Right? So I made my disposable money from IPOing a concept, a startup concept, and also recently we had a majority-owned company where we had a micro exit under $10 million in the US. So we just continue to invest in companies, exit, invest in companies, do IPOs.
Thank you. I think we have to wrap up very soon, but come on, one question from the audience.
Woo!
Finally!
Hi,
Hello.
I'm Martina from the Asian Venture Philanthropy Network, and we as the name suggests, we do venture philanthropy. So it's kind of an engaged approach to kind of philanthropy. So I was wondering about growth investments. As you said, the market is not very good for kind of a deal pipeline right now. So you will have to potentially invest money plus do kind of value-added services. So I was wondering, first of all, what does each of you do in terms of growing the company kind of beyond the cash? And then secondly, what did you think works best at each of the level that you invest in to kind of bring the startups up to a different level?
Yeah, so I think for us, we have our background as being entrepreneurs and operators first. And so as an overall umbrella value add, it's on the operations side. But where we focus specifically on is we have a lot of experience, the team has a lot of experience in operating businesses in Southeast Asia. And there are a number of very unique challenges to that. And that's really where our core value add and area of expertise is. I mean, if you look at Southeast Asia, I think a lot of investors globally look at it as one unique opportunity as a region. But the fact of the matter is Southeast Asia isn't Southeast Asia. It's 9 to 10 different countries, different languages, currencies, cultures, a multitude of different challenges to expanding across the region. So where we add most of our value is on the operational side, giving those entrepreneurs and those businesses the knowledge and the tools to scale, and then specifically how to scale in the environment that we see ourselves in, which is hyper-fragmented Southeast Asia. And that's really kind of more focused on late Series A, Series B, where the companies have really overcome some of the initial innovation-based challenges. So they've got a good product, they've been able to have some sort of initial form of commercialization, and are really looking to scale. And that's what we focus on fundamentally as our value add to the growth.
The first part of your question makes the assumption that growth pipeline kind of sucks for everybody, and I think the tone did come up from the panel, and to some degree that's true, but what you'll also see is that most fund managers will say, yeah, it sucks for everybody else, but not us, because we're awesome, right? So that's how I feel. But at the same time, like it's to your second part of your question about what we do to help. Like I'll just get real with you, man. Like everyone we hire, we get 85 people right now in 12 different locations. We hire people who are real. We hire people who like having fun. People who are just straight up. We hire people who are doing this because they actually give a shit about what they do. It's not about deploying capital. It's like a lot of the fund managers at 500, we were angel investors before this. Like I was a 2-time entrepreneur, 2 exits, and I was already deploying my own cash anyway. Like if nobody paid me to do this, I still do it anyway. So we're looking for a specific type of human being who actually loves doing this, right? Fundamentally, that's the strictest things we do. Our cultural value is have fun, get shit done. Have fun comes first. Not get shit done. That's really, really different from most corporate culture. That's how we differentiate. So most of our founders, when they meet with us, when they talk to us, we don't give a shit about a board seat. I care about like a WhatsApp seat. I want to have a real relationship with my founders. When they're gonna have a problem at 3 a.m., they're gonna text me because they know I care. So with that in mind, like that's just fundamentally it from number one. The next thing is we also make the assumption that I can't help my founders much because I'm an idiot. I'm good at 1 or 2 things. I'm like a one-trick pony. I got lucky in life, but for the most part, I'm an idiot. So what can I do? The world is changing so fast, and what the hell is going on? So I get all my founders to just help each other. Now we have a big freaking portfolio everywhere in the world. You'll always have a friend somewhere who's got an answer. So we have internal software, we're creating internal manpower to help people just network with each other and get the answers really, really fast from one another. So thirdly is we try to build a lot of platforms. Platforms like I talked a little about the M&A platform. We also have a growth and distribution platform. We get world's top growth hackers who's done a lot of big things with Zynga, Lyft, and so on and so forth. We've got like 16 of them full-time right now. And so they get deployed all around the world like Navy SEALs, just flying into top companies and working with them. In Southeast Asia, Grab Taxi, KFit, Bukalapak, a lot of top companies have benefited from this platform service. So we think of it like that. Number one, just get real, build real relationships with founders, and then it starts from there. Secondly, is to give a network of friends they can rely on. And the thirdly is build a bunch of platform services so I don't need to do the work to help the companies. I'm just trying to optimize for me to be really lazy so I can just like sit here at panels and eat nuts. So there you have it.
Yeah, I think Khailee's motto is lead, follow, or get out of the way. But I kind of endorse that. For us, our value add is really the network. And so we help companies, globally across either for business development, either for strategy. We just helped a company recently. They used to be in the US. They produce a smart luggage. Then they did a crowdfunding round. We're one of their early stage investors. Help them actually relocate to Hong Kong and help them with everything from operation, logistics, helping actually find manufacturing in China where they produce their goods. And now actually they've raised a new round, which we've helped them on the financing, and they've gone back to San Francisco. So it really depends on what the company really needs and how you can help. If you can't help them, that's fine too, but you need to really bring added value where you can. And a lot of people, I think, are saying, oh, we can help doing this and that, but in the reality, they're just more in the way than anything else.
And I think to Mark's point earlier about like co-investing, 99% of all the deals we've done are co-investments.
Yep.
Very rare we do an investment alone. We only do that when everyone really doesn't believe it's a good deal, but we still do. But most of the time people tend to agree. And so hence so between Mark and I, we've accidentally co-invested in a bunch of deals, I'm sure, we looked through the portfolio. And I think that helps bring different unique skill sets to the table. If I invest with Alex and then I need some help with Singapore government, like he's gonna be able to do that way better than 500K any day. Right? And so I think to understand what is the co-investor's strength, what's that specific angel, what is his or her strength, right? And then we can pool a group of investors to give the startup the best chance of success.
I mean, echo everybody said, basically we are just a human router. So we route human around, so that's what relationship is all about. So, but the advantage for the so-called government link is that we're able to call upon people. We're pretty much able to almost knock on every door. And sometimes those that we can't do, we can call on Big Brother.
You just knock it down. Yeah.
No, I don't knock it out. I ask my Big Brother to try to knock it out. so that is the kind of advantage that we have. But we want to build community. We build community of a like-minded investor, like our dear friend Juan was standing down there. Yeah. And these are the people that collectively we help the ecosystem. Very importantly is that one of the things that organic capability that we have, Infocomm investment have, is that we are part of IDA. IDA have a role that most of you are not aware. We are the government IT department. So GCIO, Government Chief Information Officer, which also means that we are Singapore's largest IT consumer. Every year we spend over $2 billion worth of product and services. So we become a customer, but we are able to bring the people in the ecosystem and say, if we have a product where the government can use, we'll do the introductions. So these are some of the things that we do. But collectively, we do not know that what the company needs until we know them. Okay, we don't ask for WhatsApp seed because we ask for Slack seed. Slack seed is that you can see a lot more information than just WhatsApp. Okay, so that's the kind of thing that we constantly, we are always on our startup and investing. Together with them, we're watching them all the time. So these are the things that we have to do.
I think it depends in different parts of the world. You need WeChat, you need Kakao, you need Line, you need Messenger, you need all of them.
Alright, thank you guys. Sorry, I've been asked twice to sort of finish your tale. We're all around here, the panelists, you can catch them outside until 5, so do get an opportunity to talk to them. It's very hard to get hold of them, so please harass them as much as you can. And thank you so much for attending the session. A big round of applause to the panelists.